All right. Well, let's go ahead and get started. It is 3 minutes after the hour, and I don't want to keep everybody too long on a Thursday evening. After all, this is mainly geared for busy professionals, so we want to make sure that we keep this thing moving along. So the title of this is From W-2 to Financial Security, Multifamily Deals That Changed My Life. I am Tom Kirkpatrick, the managing partner for Town Square Capital. Briefly, the agenda that we plan today, you can see that there if you are able to look. We talk a little bit about me, who I am, what brought me here, and what led me to multifamily investing. Talk a little bit about Town Square Capital and what we do. And then the real meat of the session is going to cover some brief investment case studies that I've been in. These are all deals that I've been involved in. And I'm highlighting three of the uh, most important to this discussion or key deals that are worth talking about. Talk a little bit. We've got another joining here. Hi, Miranda. Um, Market insights, just where we are in the multifamily market, a little bit on the financial performance of the case studies, uh, and then questions and answers. And please feel free to drop questions or comments into the chat as we go. I think that'd be very useful. But I think in the interest of time and me not getting too distracted, I'll hold the responses to the end and really would be glad if you came in with questions. I really would welcome questions. We'll just hold them to the end. Um, and then we'll talk about next steps for anyone who wanting to learn more or discuss more or anything like that. So I'll start with my why. As an entrepreneur, I've learned you've got to really define your why to really drive you to get up and go every day. For me, it's family, it's legacy. My wife, Stacy, she's on here listening. I'm a dad to three. You can see us here in Costa Rica at my son Evan's wedding. That's his wife, Kelly, there in the middle. Carly's on the call, and there's my wife. Um, my lifelong goal really is to build a secure financial future for my family, not unlike most folks, really, right? I'd also like to, I've always wanted to have more time freedom to volunteer. I'm scheduled to help out Habitat for Humanity here in and in probably about another month when the weather gets warm. They've got some homes here in Jefferson City that we're gonna be working on. I like doing that stuff, and hope to do more of that. And then, create a legacy, generational wealth, and like I said, the ability to donate some of that, and then helping others do the same. Part of what we'll talk about here is, who I think I can help serve, which is really what I was a very busy professional working a W-2 and worried about my ability to retire. Um, so my path to multifamily investing, uh, really a very early lesson that stayed with me was watching my father lose his job due to a corporate merger. He was president, he was kind of a high flyer, MIT grad, president of a company, but his company merged with Boise Cascade and they wanted him to move to Boise, Idaho. And he said no. And at 52, he was out without a job and never really earned. And he was a high wage earner at that point in time. Never, he did a lot of work. He did a lot of consulting, but he never really was a high wage earner after that. That kind of stuck with me. I went in the Marine Corps in there for a while. Don't have a very distinguished career, but I did go in and it gave me a lot of discipline and a very strong work ethic. despite the fact that I watched my dad lose his job in a corporate role, I went ahead and worked in a corporate roles for 35 years. So the itch to get out and be entrepreneurial and kind of control my own destiny took a while to kick in. I worked as a geologist. I've got a couple geology degrees, and then transitioned to a project manager working on federal projects that were fairly, some of them quite large. The Exxon here. I spent some years working for Exxon before I got into the environmental business. I could have put the logo of my environmental company up here. Brad and Sierra and Emily would recognize it, but most of the rest of you probably wouldn't. One of the biggest companies you've never heard of, I suppose. But anyway, so I had a growing concern as time went on, and I realized that my 401k probably wasn't really going to get me true financial freedom. I always worried about when you get ready to retire, what if you have one of those major stock market dips? And pretty much everything I had was in stocks and bonds and mutual funds in IRAs and 401ks. Um, so the turning points for me in this journey in 2016, I knew I wanted to get into real estate. This is actually, I reached out to my buddy Berlin, who's a local real estate agent, and asked him to put me on the MLS drip when any sort of a multifamily came on the market. And I was thinking about buying a fourplex or something, like ideally, maybe a duplex. And this 13 unit, this building here is 12 units, and there was another separate unit on this property. It dropped into my email literally about a week after I asked him to take a look at that. I was kind of like, it's about a mile, less than a mile from my house. And it's very nicely located kind of in downtown Jefferson City, which is, a small little downtown. But kind of checked it out, really didn't know what I was doing. I had read Rich Dad Poor Dad and knew that, you can afford to buy it if it's going to generate 10 or $15 at the end of the month and on a yearly basis. If you can just clear a few dollars, well, then great, you can afford to buy it. I really didn't know how to underwrite properties at that time, but I took the numbers that the seller gave me, pro forma numbers, which are usually quite suspect and you really have to dig in. I basically took those, discounted them, the income by 20%, pushed the expenses up by 20%, and it still cash flowed. And I said, okay, I think I can afford to buy this thing. So I bought it. Um, uh, that's one big turning point. 2023, we'll talk a little bit more about that one, quite a bit more. That's one of my case studies. In 2023, I left my job. Not yet financially free. Financially free is where you've got passive income rolling in that supports your lavish lifestyle. I am not there, but I'm close, and this particular property gave me the confidence and a nice financial backlog to be able to take the jump and do this full time. So what I'm doing now is helping busy professionals like I was diversify beyond Wall Street and build passive wealth. Town Square Capital, what we do, we acquire and manage multifamily properties with the goal of generating cash flow and long-term wealth. It's not a get-rich-quick scheme. Really, typically, the properties we look at, we evaluate and plan to hold for at least about 5 years. If market conditions are great, we might sell sooner. If market conditions are tough, we can always hold longer. So you're looking at anywhere from 3 to 7 years with some of the properties that we invest in. And really, we have two approaches that I've morphed to over the last couple of years doing this full time. I focus on local properties, within about a 4 hour drive of where I am. I say Knoxville, really, I'm in Jefferson City, but generally about a 4 hour drive, 15 to 40 units. and then we'll acquire and operate these smaller properties using professional property management and a big team. You know, Town Square Capital is primarily me on a full-time basis, but I've got lots of team members. Try to see if any of those are on the call. I guess not really. None of them are on the call, but I've got Omar helps me with marketing. My son Evan, he's a CFO, CPA type guy, helps me out a lot with financial stuff. Joaquin, my CPA. Yusuf is a guy who does some underwriting for me. Jaden George out of Nashville, he helps me kind of with acquisition and also financial analysis. Tate Seamer is a mentor of mine who's done a lot of multifamily deals. Then you've got property managers, general contractors, regular lawyers, SEC lawyers. The list goes on and on. It's a huge team sport. And so, in this local area, I've got a network with the properties I've been involved with for pretty much all of that stuff. And we can address a lot of issues. And then the other prong to our approach is strategic partnerships in larger major markets like Dallas and Charlotte. We partner with experienced groups who are much larger and have expertise in those markets, and can work very, efficiently and are able to access the best deals. And we'll talk a little bit more about that too. And I said, multifamily investing is a team sport. So again, who we help, busy professionals who want passive income without managing properties. You typically those that are interested in real estate, I try to connect with because, we can't close deals without investor funds and we can't close bigger, better deals without investor funds. So that's what try to connect with people like me, more, senior professionals who've probably saved some money, starting to think about retiring and have most of their money in mutual funds and the stock market. And then we're looking for investors who are looking to diversify. I said that, and that are seeking stable cash flowing assets. And, I mean, you can invest in a stock of a company, but you have zero control over what happens there. At least in this particular world, you can decide if you want to invest in what I'm doing, or there's a lot of other people. If you don't like what I'm doing, or uh, there's a lot of folks who are doing this, or there are other folks who are doing it. So you have more choice and more ability to do your due diligence and invest with a team that you actually might know rather than sending it off to Wall Street. And then individuals who want to invest along experienced operators, like some of the larger operators, whether that's us locally or with a bigger group. And like I said, we'll talk about that a bit more. Why multifamily? Multifamily is a very strong real estate asset class. In commercial real estate, over the past 20 years, by a lot of metrics, multifamily investment returns have outperformed industrial, office, and retail. Certainly, right now, office and retail have experienced some problems over the last few years. There's kind of a resurgence going on there. So all these things are cyclical, but multifamily has been a strong performer and has continues to be in almost any market. Self-storage is also quite a good, strong asset class, but it's a smaller market. But certainly something I haven't invested in it, but it's certainly something I've looked at as a possibility. And then multifamily stability. There's a huge demand for housing, just housing in general in the United States. And there's a huge lack of affordable housing. And, a lot of people, young folks especially, feel like they'll never even be able to own a doggone home. So there's John. We got another one. Another one joining. So, all those just really, you know, support the demand for multifamily housing. Hey, John, sorry, I didn't see you in the waiting room there for a minute. Glad to have you here. Um, and then the investment benefits of multifamily, you've got very strong cash flow potential, appreciation of the asset and growth of your equity over time. They're recession resistant. It really doesn't matter. People need a place to live. So, if you're investing in C-class properties, we haven't talked much about property classes, but A, B, C, A being the nicest, newest properties, C being older properties like the ones I've invested in around here in Jefferson City. But if you're investing in a C property in a recession, people who are living in a B property might trade down to a C property. So anyway, it's pretty recession resistant. It's not recession proof. I don't think anything really is. It's a good hedge against inflation as everything increases in price. That usually includes rents, which then puts more money in your pocket. We try to stay current with market rents. And so if inflation is pushing up the cost of everything, then we benefit from that in certain ways. And then the power of leverage, you can buy a $10 million property with maybe $3 or $4 million. As I'll show you, or in my case of some of the properties that I've been more intimately involved with, you can buy a $2.2 million property and only bring about less than $1 million to the table. So you've got that leverage. You're appreciating the entire value of that asset, but you only had to put in maybe 20, 30, 40% of what's in that thing. And then tax advantages. My son Evan just joined. He's a CPA. He knows about all this type of stuff, but depreciation and 1031 exchanges. And that's a good topic for a whole nother webinar. Try to keep this thing moving. So market conditions and challenges over the last few years, rising interest rates have significantly impacted the amount of deals that are getting done. Pricing on multifamily assets had really run up into like 2022, 23 to pretty much all-time high valuations. Rising interest rates came up and none of the deals penciled. Sellers were still thinking, well, gosh, if I would have sold 3, 5, 6 months ago, I would have gotten this. And they weren't willing to lower their price. So if they didn't have to lower their price, they just sat on that property and continued to collect rents as long as the thing was cash flowing. They had no real need to sell on a quick basis. So deal volume really dropped off. It took a while for sellers expectations to adjust to the new rates, which really has happened over the last couple of years. And compared to what we were seeing for some properties 2 years ago, 2.5 years ago, there are, 20, 25% discounts that are available in the market if you can get access to those deals. It's not everywhere, not everywhere, but they're out there, and that's what we look for. There were operators had variable rate debt prior to 2023. A very common practice for not a distressed property, but for a value add property where you were able to come in. Let's say it was only 80% occupied. You might not be able to get Fannie or Freddie agency debt on that, which is the most favorable debt terms, low interest, fixed rate, long term. You might have to get a bridge loan, and those bridge loans are typically variable rate. And what you do is you get that bridge loan, you get the funds to do the renovations over maybe say an 18-month period on a property, and then once you get the values up, you raise rents based on getting it up to market at a better product, and then you refi out, and you at like you may refi out to a agency debt at a fixed rate and get those better terms. Well, there were a lot of operators who got caught in this debt. Whoever thought that interest rates were all of a sudden going to shoot up like they did in such a short time? Nobody thought that was going to happen because we'd been sitting at, super low rates for so long. So anyway, there are operators that got into a lot of trouble, and that's been an issue in the market. And there've been some properties that have come out, and that's another. If you've got a large group who's well capitalized, there's a lot of advantages in the market, and there will be going forward to scoop up those assets that had some problems. Um, some assets are still overpriced due to past market exuberance. Um, Investors raising capital's been hard. Due to the interest rate rises, it's been very challenging to raise capital. So that's been another reason why deals have gone down. Everybody sort of was waiting for stability. Maybe we're getting there. It seems like investor dollars are starting to shake loose and so forth. So that's good. But the larger operators who've proven that they can close are getting off market and distressed deals because the broker wants to get paid. So they're just some of these deals won't ever even get put on the market. They're going to go straight to operators that are well capitalized and can close. And so that's kind of a little bit of what's been going on in the market. Town Square Capital, myself, haven't bought a property in 2 years. I've invested in other people's properties, but we haven't bought any properties. I've evaluated hundreds. Since I left my job in February of 23, I evaluated hundreds of deals, and we never really found anything that penciled up enough to jump in. So. Here are the deals that I've been involved with personally over the last many years, starting in 2016. And this is kind of a busy slide. The upper one are the ones where I was either a general partner or 100% ownership. The only one that it was 100% ownership with Stacy and I was Town Square Apartments. Um, and then these other ones, Maple Crest Square and this Equinox, which is in Chattanooga. Those are well, I'm sorry. Yeah, these are the other properties that I'm a general partner in. Just quickly, I've highlighted in green. The ones in yellow are the ones that I'll talk about further. In these general partnership deals, let me just talk briefly about these. Looking at Town Square Apartments that I showed you a picture of earlier, purchase price 450,000. Sale price 7.2 years later, 1.3 million. Um, my total capital expense, as far as down payment and money I put in was about 150,000 for the most part. So those are not the kind of returns I would ever try to promise anybody. It was a historically amazing time to be in multifamily. Purchasing in 2016, the market was just going up, up, up. Knoxville has been exploding. Jefferson City gets the spillover from Knoxville. And so it was just, so my equity multiple, my 150,000 and Stacy's and my distribution of 846. So that's a 5.6 equity multiple in 7.2 years. Pretty solid. Um, Maple Crest Square, gosh darn it. Maple Crest Square, that is another one we're going to talk a little bit more about. Purchased that for 2.2 million in 2021. My personal dollar investment was only 30,000 as part of the general partnership team. It is currently on the market for 4.9 million. Again, a historically great time. We had amazing terms that I negotiated on that one. It was seller financing. We'll talk a little bit more about that in a minute. Over the since the let's see, we started making distributions to our investors about 4 months after we closed in November of 21. My personal distributions that I've received for my $30,000 investment is $20,000. Not totally typical. That includes a small GP, a very small GP share um, that goes along with that for managing that asset, but it's currently on the market. But those are the numbers that'll kind of open your eyes just a little bit. This deal down here in Chattanooga, I'm technically a GP. I'm not particularly active in that. We took the money from this Town Square Apartments and rolled 400 grand into this property, and that allowed they asked me to be a general partner on that deal. Not just for that, but yeah. So anyway, those are the ones that I'm active as a general partner. As a limited partner, which is a totally passive investment, you can see here these my vehicle for investing in these self-directed IRA. These first three, I started out with self-directed IRA. I now have a solo 401k since I've got a business. I'm using that. I rolled everything into a solo 401k, but these are all completely passive. But you can see the opportunity here when you're investing. There's 330 units, so you're able to really take advantage of investing in a huge property. So in this particular case, we've invested 100 grand, but that allows you to, the scale of that, and with a really good operator who's very efficient in the market, has it dialed in. It's a lot of people don't realize that you even have the opportunity to invest in something like that, which I'll talk about the purchase price. I don't have it listed here, not that one, but we'll talk about the purchase price of this one. I listed. I didn't list all these, but that was a pretty big purchase price. That was my first actual passive investment. This one in Evansville, Indiana. Invested 100 grand. They paid me back 150 grand in 2.4 years. So going in, they estimated the typical, what you'll typically hear from operators like Town Square and others, were trying to double investor money in about 5 years. In this particular case, market conditions were great. They bought this in 2019. Conditions were awesome. They did their renovations. Their valuation went way up, and they were able to cash out in 2.5 years. And so I didn't get a 2 multiple. I got my money back and had to figure out where to invest it at that point, which is a whole nother topic. Is when you're a busy professional, you get these paydays, and it's often you don't even have time to really go and dig in and find another opportunity to invest in. I think some of this sat in the bank for months because I was too busy to really dig in and figure out where to put it next. So anyway, that's something, since I quit my job, I don't have that problem anymore. Able to really spend a lot more time on this stuff. But these are all different passive investments that I've made. You can see here the length of years that we had it. These two actually were combined with the same operator. Not a great performance here at all. 3.5 years, 1.3 multiple on my equity, roughly. These guys were pretty new and pretty green. I liked them. Probably wasn't they're much more experienced today. But anyway, it doesn't always work out perfectly. There's always the possibility you might even lose money, and that's the way it goes. We do everything we can to avoid that, but that's always a possibility. Let's see. Anyway, so you can kind of see, I'm going to talk about this Rise North Arlington. This is with a very large operator in Arlington, Texas, and we'll talk quite a bit about that. But here is a almost $36 million purchase. We've invested 60,000 in that. So not a huge chunk, but they're pretty trustworthy, and I'll show you some of their historical returns are pretty impressive. Um, let's see. Let me carry on and just remind anybody if you've got any questions or anything, drop those in the chat if you'd like, and then we'll definitely answer some questions at the end. And I'm getting a little long-winded, so I better move along. Town Square Apartments, my first property we've talked about. It's a C class, 450. I talked about my investment, really talked about a lot of this stuff. Yeah. So this one property really gave me the confidence and the knowledge to leave my job. I actually self-managed it for 3 years. I wanted to do it for a year just to learn that side of the business, but I really couldn't find a property manager in Jefferson City that I really wanted to have them run that property. So I did it for 3 years while I was working a full-time job. Not anything I really recommend. I tried to pawn it off on my wife. After that, she did it for a month or two and said, no, I don't think so. So anyway, we were able to find we've got quality property management now in Jefferson City, luckily. Here's another property in Jefferson City. You can see here it sits right here. This is the Food City parking lot right next door. A really nice location. The main street in Jefferson City going through the town is right close by on the other side of Food City. And you can see Carson Newman University back here. There's there's the football field, practice fields, and the whole campus is right there. So another well-located property. We actually were voted the best apartment complex in the county just this past year in the local newspaper. That's the county-wide newspaper. So that was pretty cool. This was our first syndication. We had 6 general partners. Okay, so the general partners run the deal and 11 limited partners who are passive investors. The average investment of the limited partners was about 66K. We had one guy who invested 170K, so that pushes that up a little bit. So a lot of people invested 50K in that deal, but they're all going to make a good chunk of change, it looks like. This is a C plus property with great amenities, really good floor plans. We got a dog park that we put in. It had a pool. You can see right here in this little area, the pool ended up a fiberglass pool. It broke. We had to fill it in. But that was unfortunate because it was the only apartment complex in town that had a pool. That was unfortunate, but that's the kind of things that happen. You know, we had to pay some coin to fix that, and you've always got to have enough capital in the bank to address unforeseen issues. This was a seller financing deal, as was Town Square. I started working on this property shortly after I bought Town Square. I think it was 2017. I started digging around over here, and this place was kind of a mom and pop operation. They had the phone number on the side of the pool building, which is now gone. There was a little shed, and it had the phone number for information about rent. So I started calling it. There's a guy who lived in here who was the manager for a lady who lived in Florida. And I got to know him a little bit. And he said, yeah, when I retire, she's going to sell probably about 4 years. So I called him back about 2 years later. I called him back another year after that. No. He said, I think I'm going to go another couple of years. And then 2 weeks later, he called me back and said they were ready to sell. I was the only person even involved in that deal. They'd been approached by a lot of sellers, but I established a relationship, were able to negotiate excellent interest rate terms. This was 2021, shortly before interest rates started going up. I think they had, anyway, 3.5% fixed rate interest for 8 years. It was going to be fixed. Really good interest, really good finance terms we got on that. Purchased for 2.2. The total equity needed to be closed was 183 900K was from the general partnership team, and then 913 total. So the general partners put in 20% of the total amount needed to close, and that included around 450K or so for our capital expenditure budget. I think we ended up spending a little more because we've been making a lot of money on this property. So we actually, our business plan was to renovate 20 of the 34 units and prove out, what the rents would be at a renovated product. And we've done that. We actually ended up renovating 23 units, which was a little beyond our original business plan. But we started out with a 7% pref. The structure of these deals frequently is 7% cash on cash return is what we're going to commit to giving our investors. And nobody else gets paid, including me, until we pay our investors. These 11 investors, they are 7% per year for as long as we own that. Okay. So, we were doing so well with this property. It's frequently you may not even meet the pref. Okay. In some deals, they might be giving you a 7 or an 8% preferred return. And the cash flow of the property, especially when you're first doing renovations, they're not going to be able to make that. And they're only going to maybe pay you 4%. And then they have to catch up when they sell, or maybe as things get better, they'll raise that up. But very frequently, you may not get your full pref, but you're due it at sale before anybody else gets paid, including us. So if we don't meet your, yeah, anyway, so that's kind of how that works. With this particular property, we bought it in November of 21. In March of 23, we started paying everybody 12% a month because it was going so well. The LP-GP split limit, it was 70-30. So anything above, after we pay the 7% preferred return, let's say we sell after 3 years, after we pay that, we split the remaining dollars. 70% goes to the investor, limited partners, 30% to the GP team. If we exceed an 18% IRR, which is pretty much a home run or a solid bases loaded triple anyway, then the split goes 50-50. So if we do very well and you get paid well, then we get paid a little bit better. So, it's all front weighted to make sure you get paid first, and then hopefully we get paid on the back end. And if we do really well, we get paid a little bit more. I told you it's on the market for 4.9, and we are on track to double our investor money in about 3.5 years. So we told them we'd double it in 5 years. Currently on track to, if we sell it close to our asking price, that's actually, maybe we're guessing a little slower than that. We're still tracking to double their money in 3.5 years. Okay. The other deal I want to talk to you about is this Rise North Arlington, a deal that we're invested in, for not a huge position, 60,000, but these are the types of deals that I also want to bring to my investor base. I like this Rise group has been they've been pretty strong, very aggressive, and pretty sharp guys. This is 270 units in Arlington. I told you about the pricing, 1980 vintage, so a little bit older, but that's not a bad age. Plumbing after 1980 is usually good. Electrical is usually pretty good. They had a $7.8 million capital expenditure budget for this 270 units. So far, our return on our 60 grand, since we've gotten 4,200, which is exactly what they told us they were going to do. We're getting I didn't put the pref on here, but anyway, they're meeting their projections. They're a strong team. They're vertically integrated. They do asset management. They have their own property management, and then they have their own construction company. And then they're really big. They started in Phoenix. They moved into Dallas. They've now moved to Charlotte, North Carolina area. and they just stick to a market and they have like a consistent supply chain. They use the same flooring, the same cabinets, the same faucets, light fixtures, and they buy in such bulk that they're really able to be very, very efficient in what they do. So they're usually well execute their business plan, and they are the early investor returns are on track. This is actually, these numbers are old. This was from the offering memorandum for this property in 2023. So really almost 2 years ago. At that time, they had 42 total properties, 7,000 units, 1.7 billion in purchase price. And this is the number of deals that they evaluated. They moved into Dallas. Like I said, they'd been in Phoenix. They moved into Dallas. And since they started in Dallas in November of 22, they'd evaluated 169 deals. They only had about four that came close to working. 2.3% that worked in their financial model, and their offer was almost 20% less than the asking price. Here is a brief look at the returns that they've given on the properties that they had gone full cycle on 2 years ago. So they've got a longer list now. I probably should have gotten this updated, but these, you can see the number of units here, the internal rate of return that they provided, the equity multiple. So, if you put in 100 grand, you're going to get 1.8, you got 180 grand back in 14 months. So again, it was a historically great time for multifamily in the United States of America during this period, but they were knocking it out of the park. Now, that's not to say that they haven't had their problems. If you went and Googled Rise 48, you might find that there's some stories out there that they're in trouble, and they had some loans. They may have had some variable rate deals that did kind of cause a little bit of stress on their portfolio, but they're big enough and they've learned, and they are able to they've been able to work through that. So they weren't immune from a lot of the troubles, but they seem to be coming out stronger and smarter and doing a really good job. So I'm aligning with them on the short term, potentially for additional deals, rigorous deal analysis, operational excellence. They only deal in fixed rate debt now. They buy rate locks. So they might have a variable rate product that they have to buy because they can't get agency debt for some reason, but then you can purchase a rate lock on top of that. Consistent investor distributions, solid portfolio, and this is perhaps one of the most important: the ability to source and close large deals at advantageous pricing in the hottest markets. You've got these markets that are high growth markets. These guys have capital, they're able to close, and they get the best deals that never get on the market. They do a lot of community outreach, and their employees, I think, like to work for them. They really seem to treat their employees well. I ate lunch with one of them. They're super sharp. The guys who started this company, I met one of them at a conference, ate lunch with him, and just really super sharp guys. And that's the key. I try to surround myself with really sharp people. So market outlook going forward, and our investment strategy with Town Square. There are current buying opportunities due to all the market corrections that are going on. And as I said, our investment criteria: Class B and C properties, 1980 and newer, strong fundamentals, meaning market fundamentals, which really is population growth, income growth, those types of job growth in the market, value add potential, either it's poorly managed or it needs to be renovated or both. And then conservative financing, no variable rate debt, and then the two-pronged approach that I talked about: 15 to 40 units close by, greater than 100 units with a strong operator. The other thing that is always a possibility, if anybody wants to be more active, is a JV, a joint venture, rather than a syndication with a passive partner. I may partner with folks that are more interested in being active in actually managing maybe smaller properties. So that's always a possibility. My unicorn, the thing that I really love and my passion would really be to do more adaptive reuse, like, downtown buildings, and build out multifamily in an old warehouse. That's still on the horizon. What I may do is I'm still kind of looking for operators that do that. There's a group in Knoxville called the EFANT Group that I've had met with, and potentially I could partner with them, raise capital potentially for them because those are the projects that I really love. One thing I've learned about a lot of alternative investments, I go to these conferences and these real estate guys, I'm usually, one of the older people in the room at some of them. They're just sharp and are doing so many amazing things. So, I'm invested in other alternative investments that I didn't even talk about here that I've learned about through the real estate process. And if anybody's ever interested in talking about those, I'd be more than willing. I love talking about it. Does anybody have any questions? Feel free to take yourself off mute. Let me know if you got any questions or comments. Is anybody still there?
Yeah, it was. It's John. It was a good presentation, Tom. It was really impressive. I did have a question. Do you have a property in mind, or what are you thinking there?
Yeah, right now, let's see. I guess I could step right now. I don't have a deal ready right at this moment.
Yeah,
I Rise 48 is constantly bringing deals. So likely the first thing that's probably what I'm going to do on the short term is, because I've been working to build an investor base. I have a few investors that are interested in investing and haven't, I don't personally have a deal right now. That's kind of why the two-pronged approach. I continue to look locally, but it's tough to find those gems. So that's kind of
yeah,
the answer on the short term is to continue to partner with either with potentially with Rise 48 or a group like that. I'm talking to other groups too.
awesome. Thank you. Look forward to working with you on that.
Yeah, man. Excellent. I'll see you next week. It'll be great. We're going to
Yes, sir.
shred it. We're going to shred it on the slopes, buddy.
Yes, sir. I can't wait.
So, Tom, this is Sierra. I've read a few things over the last couple of months since we talked with you the first time, and I've looked at other companies and what they're saying, and you said 25% discount earlier. And that is what I hear a lot. Like, I'm not really talking to people that much. I did talk to one company, but mainly I'm just looking at their uh, publicly available, information and
Uh-huh.
perspectives, if you will. But
For
anyway,
sure. You're doing
that
your due
term is
diligence
used a
and I love
lot.
it.
And what exactly do you mean by a 25% discount?
Yeah, I think compared to the price in the market and the valuations based on when we were getting loans at 4% interest rate or less maybe, the valuation based on those lower interest rates uh, were leading to very high values. So now, as rates went up, in order to get a deal that actually cash flows at it can't just cash flow $15 a month, right? You need to buy a property with enough cushion that you feel confident that you're going to make money for your investors, and horror of horrors that you could ever potentially lose investor dollars. So anyway, so the point is you can't pay when rates go up to here, you can't pay this price anymore. So in order to make that deal pencil, the pricing has come down 15, 10, 15, 20. I'm not saying it's 25% across the board, but there are specific examples. The property that I don't have the numbers right in front of me, but the property that we invested in Chattanooga, that Equinox at Midtown, which was called Midtown Ridge or something previously. Brad, I know you know that town. But they had an appraisal that was done a year prior or 6 months prior, and the price they were paying was 80% of what that appraisal was based on the current market. So, you know,
Okay.
does that answer your question?
Yeah, I think so, but as market conditions change, eh, I guess I would feel more comfortable if someone were talking about, well, it's a better deal now than it would have been 2 years ago because your current market conditions are what they are. Does
Right?
that make sense to you?
Yeah, so what you're saying is the property's worth less, and that's a concern for you, perhaps?
Just that I guess you know, um, no, not that the property's worth less, but it almost sounds a little disingenuous if you want to know the truth about if everything's at a big discount. Maybe it's not. Maybe it is what the current market
For
conditions call
sure.
for.
For sure. No, I can understand exactly what you're saying. And I'll agree. I mean, but I think the bottom line is as the economy improves, but I hear what you're saying. I guess maybe a discount isn't the way to say it. Price properties are trading regularly 20% less than what they were trading for 2.5 years ago. How's that? Whether it's a discount or whether it's just market conditions, um, yeah,
Yeah.
that's a good point. I like it. I love what you're saying.
Yeah. Okay, that was my question.
What
Excellent.
about raising for new development at all, or is it all value add stuff for you?
Yeah, I mean, value add is it's what I know, and I like development. Development is very attractive, under certain circumstances and in certain markets, and can be it can be a much it can be a home run in a lot of ways, for sure. I am sticking in my lane, for now. Real estate, the one thing about real estate in quotes is there are so many rabbit holes you can chase. And like I said, I go to these conferences, and you meet these people who are doing these amazing, interesting things. And I have just had to kind of put my blinders on because unless you're good at something, you're not if I'm going to actually partner with investors who are going to trust me with their money, I'm going to make sure I spend all my time focused. So development, it's not a huge stretch. It would just mean partnering with somebody who really knows development. So definitely not against it. And likely would like to do it in the future. It's just, I wouldn't say that's happening this year. Unless you got a deal for me that I can't refuse, John.
Got a pretty good one. We might
Let's
have some.
talk.
We might have something interesting with seller financing. I saw your 3.5% on that first one. I was like, wow, that's great.
Yeah,
But I think we got somebody we're looking at on a pretty good parcel that has buildings on it, but he's willing to do like 4 or 5%. So we'll see if we can,
nice. Yeah, I mean,
figure
I'll
him
always
out.
take a look and I could change my approach, Like I said, you partner with somebody who knows it, and you really, that's always a possibility. We can talk, man.
Cool, thank you.
Yeah, appreciate the questions.
When you talk a lot about Rise Capital, if I was going to invest with Town Square Capital, are you going to look to put that into something that like Rise, like you are evaluating the deals on our behalf, so it's more passive? Is that the look for you when you go at those bigger groups? So you're evaluating the bigger groups for us because we don't know how to do it.
It's not that you don't know how to do it, and you could go direct to Rise 48 and you could look them up tomorrow. What we typically, and whether it's Rise or other folks, we can usually get, we can potentially get a preferential deal by aggregating funds. If I aggregate funds and take $1 million to Rise 48, they're going to give me better terms than you can get as a retail investor showing up on their doorstep.
I got it. That makes it super clear. Okay, that makes sense. Got
Yeah,
it.
and it's so what happens is I create a fund. In
Mhm.
that particular case, typically you won't have a direct ownership in a, well, you won't have a direct ownership in a company that owns the property, which is typically
Mhm.
an LP in position at a retail level. You buy into an LLC that owns the property. Um, with when you add a fund on top of that, you're really in a fund then that invests in the property. So slightly different dynamics, more lawyers are involved. But it's a pretty good model for Rise 48. It's getting to be very common rather than have a big GP team where they bring in all these GPs, they then partner with oh, let's see, I have somebody in the waiting room. They partner with these fund managers who are able to bring funds in. So that's the goal there. And at the very least, you would get the same. You're not going to lose like because Town Square Capital is in the middle of that. You're not going to get lower returns. You would either get the same returns going straight to Rise 48, or you would get slightly better. And my goal, I haven't structured that yet. We're structuring that now. My goal would be to hopefully give investors a better than what they can get going straight to that group.
Yeah, that makes sense because you're coming in with bigger guns. I mean, that's so you can negotiate favorable terms. And now, does the fund take like a 1-2% management fee as well, and then gets an interesting split after that?
There's a basic fee that goes along with that, and then it also depends on how well the deal does on the back end again. So it's not dissimilar to a GP position in some rights. And I'm still learning about the funds. My son, who's on the call, could chime in. Evan, you want to
Yeah.
anything?
No, I mean I mean we see this all the time. It's really for preferential terms. It just gives you a little bit more negotiating power, whether it's through a side letter or what, saying, hey, you're offering your investors an 8 pref, I want a 9, and maybe a little bit better split on the promoter, the carry on the back end. So when you pull those larger dollars, we call it like fund to funds, or everybody's got a different name for it, but um, it can definitely be powerful when you're pulling large, smaller dollars that maybe, like I said, 20, 50K slugs that, together are significantly more powerful. And then from a flow through perspective, usually like as Tom was saying, the economics are going to be, very similar. You have a little bit of fees in the sense that that entity that you're pooling capital in has a tax return, so it's an additional tax return. You've got additional annual report filing fees. So there's a little bit of overhead costs that are, built in there, but usually the economics that you're going to get from pulling those larger capital dollars is going to be worth it in the long run, even with those minuscule fees that you're incurring over the life.
And can you 1031 money into your fund?
You would have to really set up a taxable a tick entity, which I don't think. I mean, it's possible, yes, for sure. It would be really more under like a Delaware statutory trust if you're pooling like fund dollars, or setting up a tick, which is a specific entity. I don't think TK, you could chime in there. I don't think you're probably taking 1031 dollars on that one right now. I don't think you're that complex, but
Yeah, I
it's definitely
think
possible.
I don't,
But
I think, I believe it is possible in the funds. It is possible to do the syndication. So, and a lot of these big operators like Rise and the other ones, they're gonna love to have your 1031 dollars, and you're actually gonna be on the deed typically. Like I said, I still have to learn how that works on a fund basis, but typically with 1031, that's so the one in Chattanooga that we're invested in, we're actually on the deed with a small ownership percentage. I mean, 400 grand of a $30 million property or whatever that thing is. Uh, that one, we are actually because we brought a significant chunk of change. It's a tenant in common, and we're actually on the deed for a 1031.
Cool.
Hey Tom, it's Jamie.
Hey, what's up, Jamie?
Yeah, me and my wife, through out the 20 years that we've been investing, we try our best to do the Roth IRAs,
Uh-huh.
and most of our investments, and all of them now, are Roths. And
Yeah.
throughout the 20 years, we have averaged a 10 to 15% on them. I mean, can you make me wanna go your route? I mean, 10 to 15% is really good in my opinion. And I don't know, I know there's no guarantees, and there are no guarantees in what I'm investing in now, but over the 20 years, we've got 10 to 15%.
Yeah, I mean 10 to 15, that's a pretty big difference. And typically the deals that we evaluate, the our internal rate of return, which is a time weighted measure of it, basically we aim for 16% or greater, 15, maybe 15 or greater. So if it doesn't pencil out to bring a 15 to 16% return or more to our investors, we typically don't go forward with it. That's pretty much a cutoff point. Now, that doesn't mean we're going to meet that, but based on all our financial modeling, and everything doesn't have to go perfect for that, but based on what we, and digging in and all the data we have, that's what we're aiming for. And I mean, if you look at, we're trying to double money, double your 100 grand in, let's whatever, I'm just throwing that out as a number, in 5 years. So that's going to be a little bit more than 10% return right there. So 10 to 15, it just depends on if you're happy with 10 when inflation is running, 5 or 6, or whether you want, I mean, a few percent that you can outpace inflation is where you're going to really start making a difference. So, yeah, I don't know. Does that answer your question? I mean, it really is just a question of taking a look at the deal. And I'd be interested. I definitely, let's get together. Like I said, either, book a, I've got my Calendly thing in here if you want to book something, or we can just schedule a time. I know I was going to call you and set something up. I've been working on this webinar actually, but maybe I'd like to hear what you've been investing in, interested to see. And if it's in the stocks, right now stocks have been running great. And stock market's been on a roll. It's hard to argue with it. But, do you feel like that's going to go forever? Look at history. And so I don't know. I don't know what you're investing in. I'd like to learn.
Okay. I'll be absolutely good with looking into that. And yeah, we're mutual funds, completely mutual funds. And
Uh-huh. Okay. Yeah. I mean,
yeah,
that's great. And it's, and it'll be interesting to see. We don't know what AI is going to do to all sorts of stuff. That's our big
yeah,
wild card.
that'll
But
do.
Roth, as far as investing from a Roth, that's definitely is an option. You can invest straight out of your Roth. So it doesn't,
So even with you, I can do the Roth.
yeah, it has to be a self-directed, right? Evan, speak up again, my CFO. Um, a Roth self-directed IRA, he should be able to invest, correct?
Yeah, so you can roll over a portion of your proceeds, whatever you feel comfortable with, into a self-directed IRA, which allows you, you have to have a trustee basically, so there's a little bit of cost built in there. But with a self-directed IRA, you could basically do with it whatever as you please. I think TK mentioned earlier, some deals that he's invested in through his self-directed IRA, um, that are still
Okay.
active, Tom, I believe.
Yeah.
The little bit of cost, can you expand on
How
that?
much percentage?
Yeah, it really depends on how many dollars you're pulling. I haven't done one
Okay.
recently in terms of
Some it does, some it does. That's a whole nother topic for another webinar too. And that's probably
Gotcha.
something I'll do in the future is get a self-directed IRA person on one of these and we can talk to them. But you're looking at a few hundreds of dollars typically, and some of them are set up on the amount of money in the account, and some of them there's a flat fee. They're pretty affordable. It depends on too, though, the service you get. If you go with like a cut rate self-directed IRA, their fees are very low. But if you ever want to transfer your money out of there, you better set aside a week to try to figure out how to get that done. So, if you go with the most reputable companies, there's a fairly nominal cost. If you can improve your returns by 3% over what you're getting now, that's not going to be that fee is going to be nominal.
Right. I just like the thought of paying my taxes now, and I know exactly what I'm going to get.
Yeah, no, that's brilliant. Yeah, I love it. And so on this next steps, one of the things, if anybody on this call is interested in doing this type of investment, whether it's with me or another alternative, or you want to invest in, something completely different, but if you want to control it, it's something to start thinking about, maybe moving if you've got a regular IRA, moving some money over into a self-directed IRA. Now, obviously, you don't want to do it too soon and have it sitting there not doing anything. But it's something to start investigating if that's something you might be interested in.
Hi, Tom. Is my audio actually working? This is Emily.
Yes, Emily, I hear
Finally
you
got
loud
it
and
to work.
clear.
Well, actually, that was a great question that came before mine because I took my first foray into real estate investing, and I learned that when you pull a lot of money out of your 401k, part of it was Roth and part of it was not. And I knew this was going to happen, but I didn't know the extent of it. It bumps you into a much higher income tax bracket. And so you owe income tax on it. And that was my question, is virtually all of my savings that I would use for something like this is in IRAs, or still my company 401k. So the and we can talk about this, at another time. Basically, how do you take it out and put it into this kind of investment vehicle without being pushed into a higher income tax bracket in the year that you pull that money out? That
Yeah,
might
you're
be
not
entirely
pulling.
a question for Evan as well.
Yeah, it's just a rollover. It's like any rollover from a 401k to an IRA. You've probably
Okay,
done that before when our
sure.
company went bankrupt a few years back.
Absolutely. Yep.
Yeah, yeah. So you've got, and that's why I had multiple IRAs. I consolidated those, but based on all the changes our company went through over the years, I had IRAs. You roll it from an IRA to a self-directed IRA. There is zero tax ramifications associated with that. It all stays in an IRA, and it doesn't impact your income at the time that you do that. Now, it certainly does. When you're investing in an IRA, you don't necessarily get to take advantage of all the tax advantages of investing in real estate, which is depreciation, from cost segregation and some of these other tactics. When you have your money outside of an IRA, it's really more powerful. But that does it's not that it's the bad thing. It's just that that's one issue. You're avoiding that whole tax. And I don't know, Evan, anything you want to say on that?
Hold on, I'm muted. Can you guys hear me?
Yeah.
Yep.
Yeah, I mean, everybody's tax situation is a little bit different. I would not feel comfortable just telling you one way or the other.
Sure.
We definitely have some tax providers that we could, jump on a call and kind of talk through your situation, whether it be a self-directed IRA, representative, or just one of our tax preparers that we use on all of our, current deals, that could kind of walk through your situation and really, curate the best plan for you.
Right.
In
Well,
terms of, hey, here's what you have. These are all Roth IRAs. These are all, traditional IRAs. What makes the most sense in terms of, if I want to set up a self-directed IRA, what schematics or what movement is going to minimize my tax burden, but also allow me to get into these, these alternative investments kind of outside the normal stock market,
right. Well, not to mention that I now have this piece of real estate that I I've paid for and painfully paid the personal income tax to get that money out that is mortgage free. That is, my plan is to use it as rental income, but it's a single family house. So it's along these lines. And it's potential, place where I could find money that is outside of a 401k or IRA. And okay, so that was a big question. The second one, and Tom, this wouldn't surprise you at all. This like analysis of properties. How does one learn to do that? Because I mean, I used to really enjoy doing phase ones, phase twos, which is a little bit different, but they were oftentimes aligned with brownfields projects because that was a big part of what I did at Gannett Fleming when I was with Gannett Fleming Engineers. So
Yeah, actually, that's another thing. I've always, I've always wanted to get involved with brownfields because of the whole real estate component to that. But to answer your question, I've got a bunch of my specialty is multifamily, right? So I have a bunch of multifamily underwriting models. Probably got 5 or 6 different ones, and I've used a lot of them. I've used them all. I've settled on a couple that I've used more than the others, but there's a lot of models, and it just depends on what. If you're looking at, single family rental, there's another model for that. My guy John Hugo, who dropped off the call, he's got those. He's churning properties in Florida right now, like you wouldn't believe, and they're buying to flip, they're buying to rent. So there's different models depending on what you're wanting to do. So let's talk. We can talk about that too offline, and I can get you whatever you need on that.
great. Thanks so much, Tom. This was extremely helpful.
Excellent. Excellent. Anybody else? All right. Well, I think we have beat a horse here. We are way beyond what I thought, and I'm so happy to get the questions and the interest. I've got my Calendly link here. I think a lot of you have my email address and my phone number. I put this up here just to keep it simple, but please don't hesitate to reach out and continue the discussion. I love talking about it, and anything I can do to help you out on any of this, I'd like to. All right.
Thank you,
Hey,
Tom.
thanks. Thanks,
Bye.
everybody. Have
Thank
a
you.
great night and a great weekend, and we'll talk to you soon.
Thanks, Tom.
Bye-bye.
Bye-bye.